The mega rich have a big problem. They have too much money. We feel for them because it means that they are unable to beat the market.
In this video, we'll show why the super rich and big institutional investors are left crying into their caviar with bog standard 8% market returns. While the likes of you and us can crank up those returns well into the double digits, let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Stake are sponsoring this video, so we want to give a special shout out to them. For those who don't know, Stake offers unlimited commission-free trading in real time and is FCA regulated.
Stake is fractional investing, so you can easily afford to buy highly priced stocks like Amazon and Google.
And Stake are giving away a free US stock worth up to $100 to everyone who signs up via our link. We'll put the link to the offers page in the description below, so be sure to check that out. Now, let's get into the video. Number 1. Exchange market size. Airlines have been in the financial news a lot recently. Once a large and steady part of the economy, the travel industry is now considered highly speculative. Say we were billionaires and fancied laying a cool million down on Dart, the company that owns Jet2. Maybe we thought this chart looked too good to ignore and fancied doubling our money.
Well, we'd have to ignore it because of something called exchange market size, and for Dart it is 1,500. This means you can only buy 1,500 shares at the market price, currently 730 pence. Our billionaire could only buy a little over £10,000 of Dart at market prices and may have to pay above the odds to get any more than that.
Also, the market is only guaranteed to buy shares back in quantities up to the exchange market size. If a billionaire did manage to buy £1 million of Dart, only £10,000 of it could be guaranteed to be sold immediately. The rest would be illiquid and might have to be sold privately or to market makers at a likely unfavourable price.
Number 2, big funds don't like volatility. It may sound strange, but many billion-dollar investment funds can't try to make too much money. They have to follow internal rules, which may prevent them from buying certain investments. Big investment funds have their reputation to protect. Volatility from up-and-coming growth stock investments could result in a large loss one year and a large gain in the next.
They'd be more worried about the large loss year putting them at the bottom of the league tables in all the magazines, regardless of long-term prospects. To guard against volatility, the big funds tend to invest in steady, big companies and less risky investments.
Number 3, ready-made excuse. Big money banks and investment companies have to play it safe to cover their backs. If the fund contains household names and one of those stocks fail, say if Apple went bust, they have an excuse ready. We had to have that stock in the portfolio. It's Apple. Everyone needs to own Apple.
While if they had tried to break ranks from their banking mates and pursue holdings in speculative airline companies, their shareholders and partners would be furious. Airlines? Now? What are you thinking? In many cases, these funds become closet trackers, but with a hefty fee.
Number 4, they'd move the market. If the mega rich tried to buy mid-cap stocks instead of the usual Apples, Amazons and Microsofts, they'd move the market. To some extent, the same applies to large cap stocks. This happened in the days after the 4th of August when it was revealed that Berkshire Hathaway had bought significant holdings in Bank of America. Of course, the market rushed to copy them.
If Warren Buffett thinks that Bank of America is a buy, that's good enough for us, they all said. So the price rocketed up before settling back down to normal a couple of weeks later. Rich guys with a public persona could in theory capitalise off the back of this phenomenon by selling what they've just bought straight away after the price moves up.
But this is really immoral, and they're not supposed to do it. There's even laws to stop them. For this reason, the mega rich have to be careful not to look like they are guilty of market manipulation, which limits their ability to sell for a big gain if the market does go up after a purchase. Luckily, we paupers don't have this problem.
The opposite is also true, where if a wealthy investor sheds a load of shares, selling them off in bulk, it is seen as a signal by normal folks that it's time for them to sell too. This can cause the market price of a stock to plummet.
If it weren't for the market manipulation rules, then this would be a great way for the rich to use their influence to get richer. You could sell your holdings, cause the markets to panic and fall in price, and buy them again at a bargain price.
Number 5, a new meaning to buying small caps. Billionaires can't buy significant holdings of small cap stocks because otherwise they'd end up buying the entire company. They'd then have to take control of it rather than invest passively. And anyway, a small cap stock which rose by around 20% would hardly make a dent in their wider portfolio. if it's only worth a few $1,000,000.
When we pick stocks, we like to have the option to assess all stocks, not just the large and mid-cap companies. Small-cap stocks make up the vast majority of companies on the stock market.
In the UK alone, there are 2,600 stocks on the London Stock Exchange, but the typically large and mid-cap indexes of the FTSE 100 and FTSE 250 only add up to 350 stocks. The others are mostly small caps. The same is true in America, with 2,400 companies on the New York Stock Exchange, and at least half are considered small cap. There is a big disadvantage in being unable to look at over half the market when picking your investments. It must be awful being too rich to buy a top performing stock.
Number 6, small caps are the best performing stocks. Small caps is where the growth is found. There's a saying, elephants don't gallop. Billionaires have to buy established stocks like Procter & Gamble and Coke and get steady market average returns. The supercharged growth stage of these big stocks is long behind them.
While a small cap company could rise 10,000 times from $50 million to $500 billion, a $500 billion company is probably at or near its peak. You can beat the big funds of the billionaires and beat the market because you can buy small cap growth stocks and they can't.
The aim with small cap stocks is to get double-digit returns at least. They are riskier, so that's why they should supplement a wider all-market portfolio, which history has shown returns more like 8% on average.
Number 7, timing. When the markets hit turbulence, a small investor can sit it out waiting patiently. Institutional investors cannot do this. One reason for this is that they need to perform in line with some benchmark, be that relative to the performance of an index or to a predetermined profit target.
A stock that falls may be sold prematurely to avoid it falling further and making the institution miss its short-term target. You and us, on the other hand, can concentrate on the long term without a need to hit short-term goals.
Advantages the rich have. It's not all bad news for billionaires. They can scrape together some decent deals via private trades.
For instance, because it's hard to sell huge holdings all at once on the open market, they might offer to buy another billionaire's huge holdings privately at below market prices. Stocks don't have to be traded on the market, they can also be sold privately.
Also, as billionaires, they probably know a lot more about investing than you do and are surrounded by experts, and so are better placed to make the best of the limited buying options available to them. Retail investors like you and us tend to lack the tools for the job.
One advantage the rich have is they don't care so much about trading fees. To them, trading fees are minuscule. To the rest of us, they can gobble up our pot. Platforms like Stake are levelling the playing field with commission-free trading.
Can normal people really beat the market? The average investor will not beat the market. They will either not try to, which is a smart move, and invest in ETFs and blue chip companies instead, or they will attempt to pick stocks and get it all wrong. But if you take the time to learn and thoroughly research your stock picks, we believe it can be done.
As well as small caps, you should emulate the mega rich by also investing in large and mid-cap companies across global markets, owning the world with the majority of your portfolio, and gradually adding in key growth stock picks to take advantage of not being a billionaire.
The mega rich are cursed with having too much money to make a decent return. Luckily, we do not have this problem and can seek to tip the odds in our favour against the market by treading where billionaires cannot go.
Question of the day. Does your heart bleed for the poor billionaires and their market average returns? Let us know in the comments below and tell us if you own any small cap stocks too. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.